Imagine this. You've invested in a rental unit in a booming Canadian city, rents are sky high, and your returns are solid. Then suddenly, rental demand drops. New government housing floods the market, financing rules are tightened, and your once bulletproof investment? Suddenly, it's vulnerable. Mark Carney just changed the game. The question now is, are you ready to play it smart? And if you're not paying attention, you could be left behind. In today's video, we're diving deep into what Mark Carney's policies mean for you as a real estate investor in Canada. From a government-led housing build-out to immigration crackdowns and multi-unit financing shifts, there's a lot happening that could affect your next deal, your current cash flow, and even your long-term wealth plan. Let's decode the risks, uncover the opportunities, and get strategic so you can stay ahead of the curve. 1. Immigration crackdown equals cooling rental demand. If you've been riding the wave of strong rental demand thanks to Canada's booming immigration, buckle up. Under Carney's policy framework, immigration caps are coming hard, and they're going to stick. Permanent residents will be limited to less than 1% of the population annually post-2027, and temporary residents will be reduced to just 5% of the population. This is a direct response to the housing affordability crisis, but for investors, especially those in student-heavy or newcomer-reliant markets, this could signal a shift you can't afford to ignore. The good news? More balanced markets may emerge by 2026 to 2027, which could actually benefit savvy long-term investors. That means less competition, slower price acceleration, and potentially more breathing room to make deals without overpaying. Still, this shift requires adjusting your expectations and strategically shifting your rental portfolios. If you're finding this valuable so far, pause for a second, hit that subscribe button, like the video, and share it with another real estate investor who needs to get ahead of these policy shifts. This info could help someone avoid a six-figure mistake. Don't keep it to yourself. 2. Build Canada Homes. The government is now your competitor. You heard that right. The government is becoming a national developer. Carney is launching Build Canada Homes, a federal agency aiming to build 500,000 homes per year by 2030. What does that mean for you? If you operate in the entry-level or affordable segment, you might soon be competing with the government, who's not exactly trying to turn a profit. But here's the edge savvy investors can exploit. Focus on mid-tier and luxury rentals, where BCH likely won't compete. Target infill and transit-oriented development in neighborhoods that won't be prioritized by BCH, and position yourself for rent-by-choice tenants, not rent-by-necessity. This is the time to adapt or be replaced. 3. CMHCMLI Select, still the best game in town. Here's the bright spot. CMHC-backed lending is stronger than ever, and it's not going anywhere under Carney's reign. The MLI Select program continues to offer up to 95% LTV, 50-year amortization, zero reliance on your personal income, built for affordable, energy-efficient, or accessible units. If you're building or buying multi-units that qualify, you can access cash flow positive deals with lower capital requirements. In a tighter market, this might be your best financing tool. 4. Urban growth, zoning reforms, create infill gold mines. One of Carney's most progressive policies is around urban densification. He's pushing for taller buildings near transit, zoning flexibility for multiplexes, no parking minimums, and support for 15-minute cities. It's not just about building, it's about smarter, denser living. For long-term investors, this is massive. You'll find more buy-right development opportunities, meaning fewer bureaucratic hurdles to build. It's easier to convert a single family into a triplex or eightplex. And the emphasis on transit-oriented development means properties near public transportation just gained more value. Policy rollout will be slow and bureaucratic. Yes, but think years, not months. If you're land banking, now is the time to double down. 5. No love for investors. Tax breaks off the table. Here's where Carney loses major points with real estate investors. No capital gains tax deferrals. Poilievre proposed this, Carney didn't. No GST waiver for investors, just for first-time buyers under 1 million, and stress tests still expected to continue. This means building wealth through real estate just got more expensive. Scaling your portfolio will require smart partnerships, creative financing, and CMHC-backed plays. So what does all this mean for you? Mark Carney's vision is clear. More regulation, more government involvement, and less reliance on aggressive immigration or investor tax breaks. But for those who adapt, there's still money to be made, and facts favor the prepared. Adapt, align, and invest smart. If you found this video helpful, hit that like button, subscribe to the channel, and drop a comment below telling us which policy you think will impact your portfolio the most. Your insight might help others navigate this shifting market. See you in the next video.